Ever felt like you're always buying stocks at the wrong time? What if I told you there's a way to invest that takes the guesswork out of timing the market? Enter dollar cost averaging, the investing strategy that could be your ticket to long-term wealth building. Hey there, smart investors. Today we're diving into a powerful investing strategy called dollar cost averaging. It's a simple technique that could help you build wealth over time, regardless of market ups and downs. Dollar cost averaging, or DCA, is an investing strategy where you invest a fixed amount of money at regular intervals, regardless of market conditions. Instead of trying to time the market, you're spreading out your investments over time. Let's say you decide to invest £100 every month in a specific stock or index fund. Some months, when the price is high, your £100 will buy fewer shares. Other months, when the price is low, you'll get more shares for your money. Over time, this averages out your purchase price. Dollar cost averaging is a strategic approach to investing that offers multiple benefits. Firstly, it reduces the impact of market volatility by spreading investments over time, which helps to average out the effects of fluctuating prices. Secondly, DCA removes emotion from investing decisions. Instead of trying to time the market or react to its ups and downs, investors follow a disciplined, automated plan. This method also makes investing more affordable and accessible by allowing individuals to invest smaller, consistent amounts rather than requiring a large lump sum, making it easier to get started and maintain. Lastly, over time, DCA can potentially lower your average cost per share, as it enables you to buy more shares when prices are lower and fewer when prices are higher, leading to a cost-effective way to build your investment portfolio. Let's look at this graph. It shows a hypothetical investment over 8 weeks. Notice how the share price fluctuates, but the investment amount stays constant. In weeks when the price drops, you're actually buying more shares. Dollar cost averaging is great for new investors just starting out, anyone looking to reduce investment risk, people who want to invest regularly without constant market watching. Getting started with dollar cost averaging involves a few straightforward steps. First, choose an investment that aligns with your financial goals, such as an index fund, ETF, or stock. Next, decide on a fixed amount you can regularly invest, whether it's monthly, weekly, or at another interval that suits your budget. Then, set up automatic transfers from your bank account to your investment account to ensure consistency and remove the hassle of manual transactions. Finally, commit to sticking to your plan, regardless of market conditions, allowing your investments to benefit from the strategy over the long term, without being swayed by short-term market fluctuations. Dollar cost averaging isn't about getting rich quick. It's about consistent, disciplined investing over time. By removing emotion and timing from the equation, you're setting yourself up for long-term success. Remember, while DCA can be a great strategy, it's always wise to consult with a financial advisor to ensure it fits your personal financial goals and situation. If you found this video helpful, don't forget to like and subscribe for more investing tips and strategies. And tell us in the comments, have you tried dollar cost averaging? What's been your experience? Thanks for watching.